Hey, so let's get started. Welcome everybody to my May webinar. Let me start that again. My May webinar, SMSF Contributions and the work test changes. So thanks for joining me. This is, I guess, really topical because we've got some changes coming up in July 2022, and we've got this opportunity now where we're sort of at the end of the financial year, so people are going to be looking at a lot of their contribution strategies. And so it's really good to have an appreciation for where the rules are currently sitting versus where the rules are going and what sort of opportunities those future rules are going to present. So one of the key issues associated with this session today is that I'm going to sort of run through at a fairly rapid pace. A lot of the concepts that I'm going to talk about, but I'm also going to back it up when I send you through the slides afterwards with a technical bulletin that I'm planning on releasing this week, which covers in a little bit more detail some of the strategies and some alternatives to the strategy. So it really sort of breaks down the numbers and the options a little bit further. So sort of rest assured that when I start talking through a number of these issues today, that I will actually sort of expand upon those in that technical bulletin. So really, what am I here to discuss? Well, I want to talk about what has changed and when it's changing. So I mean, 1 July is the key date there, but realistically, we need to understand what's actually changed from the 1st of July. I'm not going to go necessarily through all the legislative changes that have occurred. I've done those in previous sessions, but really sort of drill down on what the work test change requirements are and the effect that's going to have on the various strategies, and not just contribution strategies, but also pension strategies, because I think we're now into this blended period where historically, for many of us, the concept of the retirement phase started at the age 65. Now, I think what we're really looking at is that like genuine retirement stage, sort of where we forget everything else with the potential exception of downsizer, now kicks in from age 75, or will kick in from age 75, and we've got this sort of early retirement stage strategic planning period, which really kicks in, if not from 60 to 75, then definitely from 65 to 75. So things to be mindful of. But with these changes, it does bring some blind spots, and they're not necessarily blind spots in the sense that they've always existed, but I think they're far more in our face now with reference to when we make non-concessional contributions and the impact that's going to have on clients when we link it up with their total superannuation balance. And you know, I've seen some cases recently that reference the ATO's position still is very adamant about self-managed super fund trustees and the capacity to make genuine mistakes. And largely, they kind of feel that mistakes are irrelevant in the SMSF space. And similarly, the ignorance of the law. So the fact that we've got the law changing, ignorance of the law is not a reason to be able to go to the ATO and identify that you've done the wrong thing. So please give them mercy. So you know, they're the sorts of issues that I want to touch on throughout the session. So we will talk specifically about how the downsizer contribution can impact other contribution strategies, and that'll be sort of where I finish off the session today with the timing around the downsizer. Whether bring forward contributions are relevant beyond 2022, you know, I think the short answer to that is yes, but of course, you know, without the work test requirements there as such, it's potentially not as significant. And I think market and investment movements and fund balances is certainly going to drive the need for the bring forward contribution strategy. But when I highlighted today in the webinar, I'm really going to use the bring forward as my sort of highlighting point for how much money we can look at putting into the super environment. Eligibility for the work test exemption beyond age 67. So, you know, just realistically how that's changing from 1 July next year, and then the impact that all of this has on excess non-concessional contributions. So to me, that's the real hidden beast. There are a few others which I'll touch on when I summarize the session at the end as well, that we need to be mindful of. But the excess non-concessional contributions is, to me, the biggest impact item coming out of these changes. So I guess what I want to start with is to give us a little bit of a 1 July 21 timeline onwards. And you know, we're in a world where this year was the first year since the super reform. This financial year is the first year that we had indexation. So we've got our indexation of the contribution caps. We obviously also got the indexation of the general transfer balance cap, which gave us the $1.7 million. So therefore that had the flow on impact to the bring forward rules and the amount that we could bring forward, taking that from 110 or from 100 to 110, and therefore from 300 to 330. And I want to sort of identify that throughout the webinar today as one of the key issues, because what we have to be mindful of as part of this entire contribution strategy conversation is that the general transfer balance cap and the concessional contribution cap are not always going to index at the same time. And so I've made some assumptions through this presentation based on that fact that, and most of you that know me well will truly understand that I'm no economist when it comes to forecasting or pretty much anything actually. And so all I can do is identify trends that I'm seeing at the moment, and what we're all seeing is inflation increasing, but we're not necessarily seeing wages increasing in line with inflation. And so, there's a greater likelihood that CPI will push the general transfer balance cap up a lot sooner than a WOTI will bring the concessional contribution cap up. So I suspect that there's elements of what we talk about today that then have to be taken into consideration with future bring forward amounts and what the actual caps are going to be at that point in time. So obviously the other key issue that really took impact or took effect from this year, albeit that it came in June 2021, was the bring forward being moved to 67. So for a few people, they would have had eligibility to use that previous financial year, but for a lot of other people, they were contemplating using the bring forward in this year post age 65, so 65 and 66 year olds. And so now, of course, we get to revisit that in the next financial year to determine whether this year is the appropriate year to use the bring forward or not. And of course, the other sort of minor change, but I suspect it was a good change for a lot of people who get caught up in this space, and that is the excess concessional contribution charge that was removed for excess contributions made from 1 July 2021. If we then look at our changes sort of from a summary point of view from 1 July 2022, our key one is the work test amendment. And ultimately what it is a moving of the work test from the SIS Act to the Tax Act, and what the implications are there for claiming personal tax deductions. The expansion, because of that moving of the work test, of the non-concessional contributions right up to age 75, and clearly that is a key issue that we'll be discussing today. The flip side of that is the reduction in the eligibility age for downsizer contributions to age 60. And whilst that is probably a good measure in the sense that for those where you've got spouses where one spouse was over 65 and the other was under 65, and so therefore it does enhance eligibility for more people, we've got to look at that and say, is that a good thing for us for other strategies that we're trying to implement or look at from our client point of view? And so again, I'm going to engage with the downsizer and what that might mean strategically as we go through the presentation. And my key point, which again I will raise it a number of times through this presentation, because I think it's clearly an issue that, what are we, since excess contributions came in, I mean, that's 15 years ago. We had super reform almost 5 years ago now, but people are still making excess non-concessional contributions, even with the rules that were in place for let's call it 10 years of that. So for those that jump on board with contributions from 1 July next year, where the excess concessional or non-concessional rules effectively expand to incorporate more people, then I think it's just inevitable that we're going to see more errors and more people captured under that excess non-concessional regime. So yeah, my point of reiterating it through this presentation is one that I would hope that you also take back to your clients to drum into them, that in many respects from self-managed super funds, mistakes don't occur. What you do is what you do, whether you were aware of whether you could do it or not. So make sure that you do all of your investigating, understand all of the rules prior to making contributions, to make sure you're not going to get captured under that excess non-concessional contribution regime. Albeit that as a regime, we know that it's not as terrible as what it was many years ago. What I want to touch on, and this is a slide that I've used a number of times from identifying contribution strategies in the SMSF and broader super space, but largely a lot of these are strategies that we all talk about with various clients and trustee presentations and that as well, and advise people to go and get the appropriate advice in this space. And there's those contributions that I would consider are our general sort of inside the square style strategies, like recontribution strategies. Now, if for those that know me and have known me long enough, I've forever advocated the concept of recontribution strategies. I forever get the question about whether or not there is some form of potential for tax avoidance with recontribution strategies, and whether recontribution strategies are a Part 4A strategy or Part 4A tax avoidance issue. And all I can really say in that sense is that for the 20 odd years that I've been talking about recontribution strategies, the tax office have never really changed their position on this. Now, the tax office does change. I appreciate that, but the idea that a recontribution is a living member strategy. So once we hit age 60, 2007 really provided us with this free-for-all idea about recontribution strategies, is that estate planning is not tax avoidance necessarily, because if the purpose of super is to put money in to then draw it down yourself, if you then want to change the tax-free and taxable nature of it, it really has no significance to you personally, because it's all tax-free after the age of 60. If you are then subsequently entertaining recontribution strategies in contemplation of potential future law changes where tax-free and taxable components might not exist like they do today, well, you can only operate under the current law, not under what may occur in the future. So I've always been a strong advocate of recontribution strategies, and all I can say is that I think these rule changes from 1 July just make it like the greatest or most significant contribution strategy that we have available for us, particularly when we then contemplate linking it in with personal or spouse contributions specifically, and that whole rebalancing act. So if we look at the bolded strategies that I've got there, recontribution strategy, salary sacrifice, and then personal deductible, plus the spouse contribution, they are the strategies impacted the most by these 1 July changes, and certainly are the areas that we want to be focusing on with our clients from an opportunity point of view. But then if we look at what I would consider the more outside the square style strategic opportunities that exist, this is where potentially greater opportunities start to come into play for clients who previously felt that because of their age or whatever, they'd missed the boat. So things like foreign transfers, bringing money across from overseas, where those amounts are largely attributable to non-concessional contributions if you go through the appropriate process, depending on where you bring the money in from. So you're expanding the period of when you can bring that money into the fund. Downsize of contributions, obviously, again, is a significant strategy opportunity to come out of this. I also think the small business CGT is one that, whilst I'll only touch very, very briefly on it today, is one that gets re-energized a little bit through the extension of age and the selling of small business assets, with that 15-year qualification period and things like that. So I think there are great opportunities that exist there. But clearly areas like the bring forward non-concessional and the carry forward concessional, we have to rethink when and how we can apply those. Bring forward clearly is one that can operate all the way through to 75. For prior to the 75th birthday, and the carry forward concessional, we then have to go back and start to think about when we put the brakes on that, particularly if we've got a non-working spouse, and we want to try to introduce more money and potentially trust distributions and other elements there. And so I think we have to start to work through how all of these sorts of things will operate together. And again, when you touch on reserving and work test exemptions, they all form part of the broader strategic planning point of view. So to get to where we want to get to, and to get to the point of discussing the key issues as they will apply from the new financial year, we have to still appreciate that the rules exist for the 21-22 year. Now, I think one of the key issues that I want to identify with all of this change is probably the greatest relief to both fund administrators, but also to fund auditors, is this concept about the work test moving. But that relief for our auditors doesn't necessarily come in for really another 15 months, or I haven't done the exact maths of when they're starting to look at lodgements for the 22-23 year. But if we're looking at the fact that most auditors are currently finalising and they're heads down, bum up for getting the 2020-21 financial year audited and lodged, and then we've got the 21-22 financial year to be audited and lodged, both of those years incorporating the work test and the requirement to be able to satisfy the work test when making contributions. So these rules are still exceptionally relevant right now. And from an audit point of view, it won't be until they start looking at the 22-23 year that they're not going to have to contemplate the work test requirements, versus administrators and advisors, accountants, where we're looking at this from 1 July next year and the ability to receive contributions without having to go through the explanation of meeting a work test prior to making the contribution. That avenue changes to meeting the work test prior to the capacity to claim a tax deduction. So, it's important to still clarify the 21-22 rules. So basically, anyone up to age 67 can make any type of contribution. Downsides are obviously excluded under age 65. That's how it currently sits. We've then got those aged between 67 to 75. We've got our mandated employer contributions and member employer contributions, so salary sacrifice and personal contributions, subject to the satisfying the gainful employment requirements, or subject to the work test exemption. So our $300,000 total super balance and the capacity if we worked in the previous year to qualify. We've then got downsizer obviously kicks in as well from 65, and then over 75 we've got our mandated employer contributions and our downsizer contributions. So the rules are largely under SIS Regulation 704. They're largely convoluted as they currently sit. In the sense that you've got these different brackets and then different rules that apply within those brackets as well. So like up to 67 and how downsizer fits in, and so you've got a little bit of this mismatch of how the rules operate. So where we're heading to is far cleaner with respect to the trustees' obligations and the trustees' responsibilities. But this slide is critical for this year to make sure that anyone making contributions prior to 30 June is making them in accordance with the current rules. From a work test requirement point of view, the work test currently resides still within the SIS regulations. Now, of course, if you go to the SIS regulations, you won't find it there necessarily, because the regulations have already been updated from the 1st of April 2022, but they still do apply in the sense of being applicable to the 21-22 financial year. So we need to understand that as it currently stands, where we sit is, if people are wanting to make contributions this year, then the general rule of thumb is that the contribution must be made following the satisfaction of the work test. So, the member meets the work test, the trustee then undertakes the process of determining whether the member, being themselves, has met that work test before accepting the contribution. We've still got to go through that process. And then we've got Regulation 7044, which provides for contributions to be returned or amounts to be returned, subject to the member failing the work test or the work test exemption. So that's a critical piece. And as I said, I'm going to touch on this a few times, where as it currently stands, if we've got somebody who is over 67 years of age and hasn't met the work test, then the fund can't accept that contribution because the rules don't provide for it. So therefore, that amount would be an amount that must be refunded within the 30-day period of being acknowledged or being received by the trustee. So for the 30 days of the trustees being made aware, which in the SMSF space is ultimately the day they make the contributions, because they should have done their research at that point in time. Any contribution made when they do satisfy the work test is obviously subject to total super balance rules and the non-concessional contribution caps. And as such, if you put too much in when you've satisfied the work test or pre-age 67, then you're subject to the excess non-concessional contribution rules. So that's a key point to understand, because where we then move to from the 1st of July is, as you can see based on this table, a far more aesthetically pleasing for one thing, but a far more simpler set of rules with regards to the ability to make contributions. And that is simply, if somebody is under the age of 60, then they can receive employer contributions or member contributions. If somebody is not under 60 but is under 75, then they can receive employer contributions or member contributions, including downsizer. And if they're not under 75, then they can only receive those mandated employer contributions or downsizer contributions. So what we've seen is the removal of the work test from the SIS regulations between that period of 67 to 74. So we've simplified that. All of these rules then incorporate, or that rule sort of in the middle there incorporates accepting contributions up to 28 days following the month in which the member turns 75. So there's greater clarity around that 75-year rule, which often got misinterpreted previously, where it was in the legislation, which talked about contributions that were for a period when the member prior to when the member turned 75. So I think the wording on this is far clearer and gives a greater understanding for people to know that they can make that contribution in the 28 days in the month following when they turn 75. So that extends the period for potentially up to 58 days or whatever it might be if they're born on the first of a month as such. But they're the rules to be mindful of. However, all contributions pre-age 75 are going to be subject to the excess contribution rules. Now, does the capacity still exist, or will the capacity still exist for people to make genuine errors? Arguably, yes. Will you be in the lap of the ATO to argue that point? 100% yes. I think most people just have to take it on board that if they contribute prior to age 75, then that contribution is going to be measured against their total super balance to determine whether or not they are eligible to contribute. And if they're ineligible to contribute or their cap is 0, then they are going to be subject to the excess contribution rules. So from a thought process point of view and from a fund process point of view, the key issue will be that we don't go through the conversation of, if you put that amount in and you're not entitled to, that you can pull it out within 30 days. So that's our rule of thumb now. If we're talking to somebody over 67 who no longer works, we say you need to pull it out as soon as practicable, because the auditor has the possibility of reporting it if you don't refund it within that 30-day period. Now we have to reverse away from that from next year and say, look, the money must remain in the fund until the ATO engage with you under the excess non-concessional contribution regime. So I think that's a real key issue that we need to address with our clients right away, because how many clients have in the past done the wrong thing over age 68 or whatever, and effectively been told to refund it, and so that's their mindset. And again, I refer back to the case I was recently reading about, and I'll put a reference to that in the technical bulletin. But the case that I recently read about was one that they weren't aware, and it was to do with the changes that occurred from 1 July 17. They said, we weren't aware of the changes that came into effect that day with regards to the contribution rules. And the tax office basically said, and then the Administrative Appeals Tribunal effectively said, well, it doesn't matter that you weren't aware, you should have been aware. So you can't use ignorance as a reason for making a mistake. So again, be careful and be mindful of how those contribution rules are going to work from the 1st of July. So from a work test point of view, and we'll get into the strategic things in a moment, but to finish off the more technical elements of it and the legislative references, the work test requirements are now embedded in the Income Tax Act, where we have the capacity to claim personal tax deductions. So in section 291(65), it basically imposes a requirement now that if you make the contribution between the period which commences on the day of your 67th birthday until 28 days following the month of your 75th birthday, then you must be gainfully employed. You must meet that gainful employment requirement during the year to be eligible to claim a tax deduction. Alternatively, you can satisfy the requirements of the work test exemption. So the work test exemption has been picked up and moved from the SIS regulations into the Income Tax Act. So the key point there is that really what they've done by tidying up and linking the SIS regs and the Tax Act together here, they've said the rules about contributions are exclusively age-based, right? No other criteria. The eligibility for how much you can put in come back to Tax Act, like total superannuation balance will determine whether or not you will create an excess non-concessional contribution. Again, areas that are driven by the Tax Act. So trustees are basically into a position of can we or can we not accept this amount, right? And the short answer is going to come down to their age. Members, albeit the same person, need to understand how much can I contribute based on my total superannuation balance, how much can I claim based on do I satisfy the work test requirements for that period, that 8-year period between the 67th birthday and their 75th birthday. So again, I think it actually is a very tidy set of amendments in reference to how the rules operate. We've just got to then make sure that the clients are understanding that and undertaking the right process. But one of the key issues that we're going to see within this strategic change and this legislative change is the timing of contributions, and most definitely the fact that clients will have moved into retirement phase is that whole concept of making contributions to potentially recommence pensions and also claim deductions is it probably becomes a lot more critical now, the concept that once you start a pension, then you can no longer claim a tax deduction on the contributions that went into starting that pension. So, really critical timeframes around the capacity to claim the deduction prior to commencing pensions. So that will trigger a lot of issues for clients. But the other one is the proportional deductibility. And again, I've expanded upon this in the tech bulletin, but the proportional deductibility where you are actually drawing down benefits as a lump sum from an accumulation interest. And now this becomes a fairly critical point, because strategically we are all quite heavy in promoting the idea of if you take lump sums, if you've got pensions and you take above the minimum, then are you going to take that amount as an excess pension payment? Are you going to take it as a partial commutation from a pension interest? Or are you going to take it from an accumulation interest because you've got unpreserved benefits? Now, if we're taking it from an accumulation interest and we're doing that having made a contribution that we're wanting to potentially claim a deduction on, we need to make sure that deduction has been claimed prior to the amount coming out, because otherwise the lump sum will have incorporated a proportionate amount of tax-free benefit. So little triggers like that become sort of far more technical in a space where we're doing or seeing a lot more strategies of lump sums and pensions coexisting together, which of course is relatively new, albeit that people have been able to do it for a long time. It hasn't been as commonplace a strategy. So one to be mindful of. So if we look at the strategy considerations, then what I sort of see as being the key strategies that are impacted by these changes, well, clearly downsizing is going to be one of those strategies. The recontribution strategy, most definitely, as I said, I probably should have put that number one on the list there. The bring forward non-concessional, again, really more about the need to utilise the bring forward amounts, and I think a lot of that's going to be based on where members sit in their total super balance regime, as far as how far away are they from the qualifying points for the bring forward eligibility. So I think that becomes a fairly important issue for a lot of clients there. The carry forward catch up concessional, really we have to look at that, and again, if we're starting to implement some of these strategies together, that what we're looking at is, do we have the capacity to do the carry forward catch up prior to entertaining multiple spouse contributions over, let's call it a 10-year period or whatever it might be, to rebalance the fund to a 50-50 nature versus heavily invested in one member versus the other. So do we engage in the carry forward catch up prior to one member triggering that 500,000 and prior to them hitting age 67 if they're no longer working. So again, all of that I think is a relevant piece of the strategy puzzle. And similarly with the concept of contribution reserves. And I've got an example there to look at in a moment with regards to the 21-22 year as to what we could potentially be looking at this year versus next year with that situation. And then of course, throughout all of this, because we are talking about contribution strategies in the traditional pension timeframes, we need to know what it actually means from a pension commencement point of view. And so I think they're probably the key issues that we need to address when thinking through these new contribution strategies when dealing with our clients. Of course, the first real key part to all of that is the total superannuation balance. So we know that that total superannuation balance is going to be relevant for recontribution strategies. It's also going to be relevant for spouse contributions and the capacity to effectively receive foreign transfers, so transfer money in from a foreign jurisdiction. So our total superannuation balance at the previous 30 June is still going to dictate the various strategies that we look to implement for our clients. And you know, it's often spoken about, and it's not a focus of the webinar today, but you know, the capacity to, I guess, dig deep into the investments of the fund and identify whether there are any genuine opportunities within the fund to reduce a member's total superannuation balance, and then justify that or back it up if you make a manual adjustment. So appreciating that the member statements and most of the software are going to produce a total superannuation balance, but if you're looking at deferred tax liabilities and other elements, selling costs down on real estate investments and things that may actually reduce the balance of the fund, then you can look at making manual adjustments to that total super balance, which may assist you either A, getting under $1.7 million as it currently stands, or more importantly, getting under that $1.48 million to be able to utilize the full bring forward provisions. So, you know, the whole timing of a lot of these strategies is going to be relevant with reference to total super balance 1 year, contributions in the next. And so the whole idea of, again, the timing of our downsizer, the timing of large withdrawals from our balance, all of those sorts of things will come into play to determine what is the appropriate time to undertake each transaction. We can then go further into looking at the things like salary sacrifice and personal deductible contributions and their link to the carry forward catch-up rules and the total super balance of $500,000. As I said, for a lot of people that we potentially will look at using these strategies for, they may have balances over 500,000. But on the flip side of that, you know, where we've come from 2017, where we were forced into splitting those with more than $1.6 million, we were forced into a world of pension and accumulation. And if they had spouses, so let's go back 4 years, 5 years, and have a client with $2.5 million with a spouse with very little money in super, but the spouse was also over age 65. Well, then all we could really do at that point in time was either conjure up some form of employment for that spouse, which was largely unlikely, or we would just have to wait until effectively the death benefit was paid, and then a significant portion would have to come out of the fund, and we would transfer the balance over to the spouse at this point in time. So we've kind of sort of sat there in this period where you've got this imbalance between member balances, whereas now, with the changes from next year, we actually can look to address some of those accumulation versus pension interests and moving money from one spouse to the other, which one enhances the potential for the ECPI deduction within the fund, so the tax offset there, but two, it provides, I guess, a good look into the estate planning process, which inevitably a lot of these strategies turn out being relevant for. So, you know, whether or not we talk through estate planning in the sense that we all appreciate that all of these things and paying pensions do have an estate planning element, regardless of the fact that super is in theory not there for estate planning purposes. We have to plan for the fact that all members will die. And so if we can effectively make it more tax effective, then we're in a better position. So the total super balance is a fairly fairly significant issue associated with everything that we're trying to achieve. So the first strategy I wanted to speak about very quickly is this whole contribution reserves situation and the doubling up or the increasing of the deduction. So if we talk about and understand that the contribution must be allocated within that 28 days following the month in which they're received, and you know how much longer as we expand and delve into SuperStream in the SMSF space, you know, at what point will SuperStream, if ever, you know, I just put it out there, put it on the table, will SuperStream ever sort of bring that that contribution allocation timeframe back to say the 3-day period that SuperStream requires, or whatever that shortened period is, which much less than 28 days, which really narrows the capacity to use certain strategies like the contribution reserving. Now, largely for a lot of people now, contribution reserving is about that deductibility and getting more of a deduction in one year because you're going to have lower income in the next year, and that doesn't necessarily change. But where it changes is because you have to satisfy the work test prior to or post age 67 moving forward, is that if you've got other income this year and the member has turned 67, then is there an opportunity to bring forward the deduction from next year into this year to offset the member's taxable income? So by making that contribution, and again, the first contribution doesn't have to be made between July and the 1st of June, but I like the idea that it's made as a separate contribution, and then they make a second contribution of $27,500 between the 1st of June this year and 30 June, and then they allocate that contribution into to the next financial year. So again, all legitimate under the way that legislation's written. The client would need to complete the appropriate form that the tax office have to reallocate that concessional contribution, because the fund does need to report the $55,000 under the contributions in this year. However, it gives us that capacity to claim that deduction of $55,000 because the deduction is claimed in the year of receipt, not in the year of allocation. But if you take that one step further, you know, what was their total super balance at the preceding 30th of June? Was it less than $500,000? Have they not made or not utilized their full concessional carry forward amount from the previous 4 years? Because if we've got like excess amounts from those $25,000 contributions from the prior years, then do we have the capacity to use an element of carry forward this year and an element of contribution reserves to maximize their concessional contributions in the year of 67 before they're ineligible to claim it? And I think that's a strategy that we can then continually look at, is in the year that they're turning 67, so long as and again, so I'm only going to work for those that turn 67 potentially in June to be able to make that last contribution. But the capacity to use the contribution reserving, I think, is something to be mindful of. But with the link up with the work test, there is an absolute opportunity to apply it this year. So I just wanted to raise that as probably not as significant as the non-concessional contribution strategies, but one to certainly be mindful of with the rules changing around personal deductibility. But before I talk about using the bring forward and that, I want to address, I guess, a couple of key issues associated with the downsizer contribution. So we are going to be eligible to use the downsizer from age 60 and over from the 1st of July. So, you know, if you've got clients, because you've got that 90-day period to make the contributions, you may have clients that don't turn 60 until June or July, but they've sold their house now and settlement doesn't occur until next year, or settlement occurs now they sell now and settlement occurs within 90 days, then potentially they can make that contribution in the new financial year if they turn 60 at the beginning of the year. So, you know, we can be looking at the downsizer rules right from now, because it all comes down to the point of when you're eligible to make the contribution, not how old you are when you sell the property. So therefore, you're going to have people who are turning 60 or have just turned 60 now who are looking at selling their houses, and you know, there's still people out there in that selling market. We know that interest rates and things may quiet things down, but it's still a lot of activity in the property space at the minute. So we've got the rules and the requirements that we need to be mindful of. But I think there's a couple of other key issues that that the downsizer changes need to be addressed, and that is that if we use that as a strategy from age 60 to 65, then those contributions are going to be preserved. So right now, any downsizer contribution that's made post age 65 is unrestricted, non-preserved. Right now, even if technically it gets preserved on the way into the fund, it's immediately unrestricted, non-preserved because they've satisfied the condition of release of turning 65. So we assume preservation becomes an issue. The other thing is, by utilising the downsizer contribution from age 60, then it's likely to topple over a lot of our strategies, such as using that work test exemption in the year following our retirement, or using the carry forward concessional rules pre-age 67. So the downsizer from age 60 is a nicety for those who qualify and potentially aren't going to go down too many other strategic points with regards to their contributions in their fund. But for others, it is going to have an impact because it's in itself is not measured against the total superannuation balance for whether you're eligible, but will count towards the total superannuation balance when you're trying to determine eligibility for other things. So clearly a key issue that we need to be mindful of. And so therefore, in saying that, it will then not only potentially knock you out for the work test exemption or the carry forward concessional, but may also dilute the capacity to make non-concessional contributions. So, I'll touch on at the end a strategy to contemplate in that space that I think the new rules potentially provide opportunity for, whether it's necessarily something that clients would be willing to engage in, but the timeframes and the eligibility requirements, how they all work together, I think is quite interesting. But if we look at the bring forward thresholds as they currently sit, and it's important to reflect on these because, again, I go back to my comments earlier in the webinar where I touched on CPI, and I touched on the fact that I think that CPI is advancing at possibly a quicker rate than average weekly ordinary times earnings. So does that mean we will see indexation of the transfer balance cap prior to indexation of the contribution cap? What does that mean for this table? Because this table, there was some nice symmetry when we moved across for this year, but if the numbers differ, so if we've got a general transfer balance cap change, then the numbers on the left will change. The less than 1.48 number will change, and the 330 won't change. But if we get a change to the contribution rules, but not the general transfer balance cap, then it's going to be the other way around. So we need to keep that in mind. So what I want to look at, and again, this is a speculative suggestion, and what I have tried to do in here is I've tried to make some general assumptions around the indexation of the general transfer balance cap. And so we look at that period of time from age 65 to age 74, previously a time where largely our capacity to make contributions had diminished because of things such as the work test. So now what we look at is we've got a client who at 30 June 2022, this year, has a total super balance less than 1.48 million. So we know that the general transfer balance cap is not indexing this year. So they can make $330,000 contribution from the 1st of July, and then nothing in the following 2 years. If we then go forward to 30 June 2025, then the total superannuation balance, I'm going to put it out there and say that it's indexed up to $1.8 million. And I'm also going to say that we've got an indexation of the concessional contribution cap at that point. So the concessional cap's jumped up to $30,000. So that brings our lower threshold for the bring forward amount. It takes that up to $1.56 million, which then means that we're eligible to make $360,000 non-concessional contribution because we've got $120,000 each year being 4 times the concessional cap. So that's sitting nicely in that space. But then we see the general transfer balance cap again jumping up now to $1.9 million at 30 June 2028, because I'm identifying that inflation will continue at this point in time, but we don't see a change in the concessional cap at that point. So we contribute again that $360,000. Now this could be a period in time where you actually look at that strategy, and in that year between 71 and 72 years of age, you only make the $120,000 contribution, because the client potentially or the awardee change might happen at 30 June 2029. And so at 30 June 2029, then the following year, you might make a $130,000 contribution, and the following year after that, you might make $130,000. So, it's balancing whether the bring forward is appropriate and locking yourself in. And I think it's hugely likely that we will see the disassociation between the indexation of those two caps, if not in the next cycle, then likely in the cycle afterwards. And so, the use of the bring forward, albeit that it's only, negating a $10,000 contribution each year, but, that $10,000 can be significant to some member balances to offset any tax liability. And then if we look at the final one, which is, in a timing sense point of view, based on the current set of rules, this final one is a critical one, because we're 74 on the 1st of July that year. So if we're 65, if our clients are 65 on the 1st of July 2022, then they're going to be 74 on the 1st of July 2031. And that is going to give them eligibility to utilise the bring forward amount in the year that they turn 75. And that's significant because, and this is a bit that's been a little bit or slightly misunderstood through various parts of the industry. In the initial explanatory memorandum and the initial conversation about the bring forward, there was a discussion piece, and it was effectively in the explanatory memorandum that the government or Treasury were looking at introducing legislation that would taper the bring forward amount off, because there was no opportunity to contribute once you'd turned 75, 76. The legislation was not written that way. So effectively, right up until that 75th birthday, you can make and utilize that bring forward contribution in that final year. So in this instance, right, and assume that we've got a higher or $2 million general transfer balance cap, and assume we have then got that third level of indexation on the concessional caps, then our client can contribute $390,000 in that year. So that gives us the capacity to contribute $1.4 million of non-concessional contributions. So that's a very significant rebalancing between one spouse to another in a spouse superannuation fund. It's a huge opportunity for those that have come into significant wealth later in life and don't have huge superannuation balances. And again, that might be from the sale of property that is over and above the downsizer contribution. So there's any number of reasons why people come into that wealth later. But whereas now or previously we had to try and find ways to put that money in before 67, now we can spread it out over that period. So it's not just about increasing member balances, but it's also about estate planning. So what we might see is we might have the situation where the client that already has that 1.7 or around that total superannuation balance point of view, but a lot of it is taxable benefits. They might look at this as a strategy from an estate planning point of view and look to draw down large amounts or entertain that recontribution strategy on a 3-year cycle. And I think that's one of the sort of the key pieces to the puzzle, is that you've got the obvious rebalancing for spouse accounts, but then you've got the transformation of taxable component to tax-free by using multiple pensions. And what that tends to look like is a situation where you, and again, feeding into, we're going to be in a new world soon with having definitive answer on binding nominations and their lapsing period or non-lapsing capacity once we hear from the High Court in that regard. But we'll have this capacity if we draw down, for example, significant partial commutations from the accumulation interest from the pension interest, and then we recontribute those amounts back in. So if we take our $360,000 out of our existing pension on the 30th of June, 2024, 2025, we pull out the 360, and then we put that in on the 1st of July. Well, our total super balance has been reduced by that 360 the previous year. We're then giving ourselves that eligibility to make that non-concessional. We then put that into a new pension and lock it away as a tax-free amount, and then potentially we can then distribute that external to any potential pension that's being paid to the spouse. So we're creating that tax-free environment. We then look and potentially repeat that process on the 30th of June 3 years later, and 30th of June 3 years after that as well. So we then turn ourselves into a position where, 2 years ago I was doing this sort of presentation and saying that those people with average self-managed super fund balances based on ATO stats, which were somewhere about between the $400,000 and $600,000, those people under the bring forward rules had the capacity of effectively washing, and I don't like to use the word washing there, but had the capacity to take a large portion of their taxable component, if not all of it, and make it tax-free. Now we're saying those clients of ours who effectively have balances almost up to, or basically effectively up to their general transfer balance cap, can regenerate almost all of it, $1.4 million over a 10-year cycle, into tax-free component, which of course has huge estate planning ramifications, because on $1 million, we're talking about $150,000 worth of tax to a non-tax dependent if it's all a taxable component. So if we're engaging in strategies that's saving that sort of tax from an estate point of view, then that's pretty significant. And I'm sure our clients will all agree with that. So the whole idea of looking at these contribution rules in isolation as just ways of getting more money in, or moving money from one spouse to another spouse pre-estate planning from a total super balance and transfer balance cap point of view, it's also a way of identifying and dealing with the inevitable in what 80% of self-managed super funds, or whatever the number is, the inevitable second death benefit, where we're paying to non-tax dependents, whereas that first death benefit is often to a spouse, and therefore doesn't have any tax ramifications at that point in time. Which then sort of brings me back to the idea of, well, how do we engage in this strategy with reference to the downsizer contributions? And what we look at is to say, okay, well, downsizer contributions are not driven by the total superannuation balance, but neither are the CGT small business concession contributions, and similarly the structured settlement contributions. But I think if we look realistically, that they are the lesser of the three contributions made, albeit they're the greater from a sums point of view. They're the lesser from a regular activity into the SMSF space. That downsizer and small business contributions, the timing of those becomes fairly relevant. And so if we look at that downsizer being reduced to age 60 and the 10-year qualification period associated with the downsizer, then what we can actually start to look at from our client's point of view is if they sell their house at any time from age 60. So for this example here, I've identified that they're selling it in the year that they turn 60, then don't use the downsizer contribution or contemplate not utilizing it at that point in time, but rather make non-concessional contributions or utilize the concessional carry forward amount to offset other income if they've got lower than that $500,000. Because then potentially we can start to look at that strategy of the 330, the 360, the 360, the 390 that I identified before, as ways of making recontributions or putting excess money in, depending on how much you've got from the sale of the house. You've got the capacity to still use the non-concessional contributions at that point in time, rather than potentially knock yourself out by making a $300,000 downsizer contribution. Because then what we can look at is, okay, well, once we hit 70, there's a very strong chance that we've actually now been in a new property for that qualifying 10-year period that we have to hold and reside in from a primary residency point of view. We can now look and say, okay, well, if we're looking to downsize again, because we are becoming less active or whatever, then in post that sort of early retirement stage, then we can look to use the downsizer contribution, or potentially we move from one property into an investment property, and we use the first property. So rather than sell the investment property and create the tax liability first, we've then moved into it and created the partial CGT exemption, but eligibility for the downsizer later, and then we can use that downsizer strategy post age 70. But in addition to that, we also can look at the fact that we may now also have the capacity beyond age 67 to sell down a small business, so an asset that would qualify for the active asset test, because it's been used for X number of years, at least half of its life or whatever. It's been held over 15 years. It may help and may assist in qualifying for the 15-year qualification period, because you've acquired that asset, the small business asset, at age 55 or age 50 or whatever, and therefore you've taken it through to age 70 before you're selling that small business asset and qualifying for that CGT concessional contribution after the event of all of your non-concessional contributions. So all of these things sort of come into the broader strategic planning for our clients. So really that was a key issue of what I wanted to address today, was that these opportunities, I think, they just broaden what we're able to do in the SMSF space in that 10-year time frame from 65 to 67. Call it 67 to 75, sorry, if you choose to, but I still look at the condition of release at 65 as being the pension trigger. So it gives us that 10-year period from our traditional retirement through to age 75. But of course, there are then our considerations associated with all that. So whilst there are some great opportunities for the downsizer and recontribution strategy, spouse contributions at that point in time, we do have to consider the things like the deductibility rules. So as I've addressed earlier, the capacity to claim a tax deduction on contributions made is really comes down to the whole idea that you are claiming the tax deduction, notifying the fund with the intention to claim the tax deduction prior to a pension commencing or prior to a lump sum being withdrawn from that accumulation interest. Now, of course, if you then claim that and are then not entitled to it, well, then you're getting this amount treated as a concessional amount, so the tax is being withheld on it, but you're not getting the deduction for yourself because you can't vary that notice down after the point in time. So you want to be certain that you're entitled to that deduction when you go to claim it and you lodge your notice of intention. So deductible contributions do become a bit of a quagmire in this new environment. There's always the inherent risk of future budget restrictions. So whilst we're operating now in an environment where largely the super changes over the last 2 to 3 years have been, from an industry point of view, quite positive. The removal of the work test has been an issue that's been on the radar for a long time from industry representatives, and so to see those changes come to fruition is quite positive, but that's not to suggest that it won't have negative changes. So we need to be mindful of those negative changes may come in and implement it, which then again gives further credibility to the idea of undertaking recontribution strategies while you can, so that therefore you've got a better tax-free outcome in the event that tax is reintroduced over age 60, or there is tax from a death benefit point of view. Who knows what, and I'm not suggesting that either of those two things are likely to occur. The other thing that we have to take into consideration is the risk of market movement. So, how is our planning affected by a surge in the market? It's obviously benefited when there's a decline in the market and our balances drop, and therefore our contribution opportunities extend. But if the market is increasing significantly, then that's where bring forward versus annual contributions may be more appropriate, because we don't know necessarily whether we're going to qualify to make $110,000 or whatever it is in 2 years' time. And again, got to consider, as I highlighted before, the estate planning ramifications of two-member funds versus that sole member fund, and that is that tax is inevitably applicable on the death of the second member when the benefit is being paid out largely to adult children, whether it's via the estate or directly. So, a lot of these contribution strategies lend themselves nicely to getting the fund prepared for that estate planning process, but then the issues that are associated with running multiple pensions and what that all means for the fund. And I guess now that we've also got the 50% pension reduction in place for next year, it's an opportunity to say, okay, well, what are the client's drawdown needs? How much of it's going to be pension? What can we utilise from a transfer balance cap reconfiguration. You know, do we want to take lump sums? Do we want to do partial commutations? Do we want to take it from an accumulation interest? All of those sorts of things form part of the entirety of the strategy consideration. So I think there's a lot more going on in our heads now strategically than what has over the last few years, and the last few years have provided a huge number of strategic opportunities. So this just enhances on that without even contemplating things like First Home Super Saver and other changes that have taken effect. So look, that's it. Thanks for joining me. As I said, I will have a technical bulletin out to you with the slides which will enhance on some of those strategies and the considerations of each of those strategies, but also address, you know, lower member balances versus higher member balances and things like that as well. My next webinar is on the 8th of June, and that will be my SMSF Pension Planning Toolkit, which is a session that I ran recently at the SMSF Association, and it certainly identifies a lot of the key issues, and particularly now in contemplation of what I've spoken about today, sort of is a building on to that whole contribution strategy consideration and reversionary versus non-reversionary pensions, particularly how they impact total super balance as well. So a lot to discuss in that session. So thanks for joining in today's session. And unless there's any questions, I look forward to catching you all at our June webinar.